some of this. I'm sure there are people here that have full-time artist endeavors. There are people that do it part-time, people that are thinking about it, people that are incorporated. So some of this stuff may seem pretty basic, or some of it may seem very complex depending on what you're doing. So, but I always start with the tax stuff because that's, especially now, that's what people think about. So the general rule in terms of what artists can deduct, and this is true actually for any profession, is the golden rule is reasonable and necessary for your business. And then in America, it's actually pretty much, I shouldn't say this too much because then people won't ask for my help. It's pretty much a voluntary system. Most people do not get audited. So that said, so there's a lot of stuff that you use your best judgment on, and hopefully your most honest judgment. But reasonable and necessary is pretty much determined profession by profession. And then it may be even different in your profession. So what's deductible for an artist or what's reasonable for an artist may not work for somebody else. But there are some broad categories that are consistent. Now, most of what I'm going to talk about is if people are freelancing. In other words, freelancing means you get a 1099, you have your own LLC. In other words, you're not employed by someone else. So you're subject to the evil self-employment tax. Is it anybody who doesn't know what self-employment tax is? Okay. So thank you. That took some courage. So self-employment tax, there's income tax, there are a lot of taxes, but there's income tax, there's self-employment tax. Social Security and Medicare are self-employment, well, they're payroll taxes if you're employed by someone else and you have taxes withheld. You, for the most part, you have no say over that. It's done automatically. So you're an employee of the city of Cambridge. Well, cities are actually a little different. You're an employee of Artisan's Asylum. You have 6.2% of your wages taken out for Social Security, whether you like it or not. Whether you hate Social Security, whether you need it or not, it's taken out. And then you have another 1.4% taken out for Medicare. That's 7.65% because I'm rounding a little bit. In addition to that, also what you don't see is the employer matches that. So Social Security and Medicare basically are essentially 15% of wages go to the government for that. Half, as you're an employee, half comes from you, half comes from your employer. When you're self-employed, guess what? You're the employer and you're the employee, so you get to pay all 15%. That's why when you're self-employed and you just made, say, a few $1,000s, you're suddenly stunned because not only are you paying income tax, like on everything else, you're also paying an additional 15%. For a lot of people, if you're making, say, under $50,000, and if you have a family, you might actually be paying more in self-employment tax than in income tax. So that's the scourge of self-employment. And I do have a lot of opinions about how it could be changed, but that is what it is right now. If you're an employee, for the most part, you cannot deduct your out-of-pocket expenses. The presumption is if you're an employee, that most of what you need is being covered by your employer. If it's not, you can deduct them under two scenarios. One is that you itemize your deductions. That essentially means that you own your own house and you have deductions for property tax and mortgage interest. But over and above that, even if we do that, there's a percentage of your income that's a floor, which basically means, say you make $50,000, the first $1,000 of those unreimbursed expenses will not count. So basically what I'm saying is, if you're an employee, unless you're a salesperson or somebody who has tons of really legitimate unreimbursed expenses, don't even bother. That's the general. Okay. So there are two types of expenses, again, mostly for self-employment. One would be direct expenses. So again, anything you're in business to make a profit. You may not be making a profit, but the presumption is, or the intention should be, you're in business to make a profit, and any expenses you pay are deductible. So direct expenses are things like paying subcontractors, paying your marketing team, paying your accountants, paying for supplies, paying for rent, all that stuff. The rule I always think about is, if you were not doing this business, you wouldn't be paying for these things. Direct expenses. So direct expenses are just immediately deductible. Again, if they are related to your business. And I know there are all kinds of gray areas that will be most of the questions and answers. Indirect expenses are a little fuzzier. So indirect expenses can be, I have a cell phone. I use it for business and I use it for personal. How much do I deduct? I really don't know. There's no guidelines on some of this stuff, really. And some of the stuff, the IRS is not terribly well funded, and things change very quickly. So, for instance, cell phones, I mean, it seems like they've been around forever, but they really haven't. I've never seen any guidelines for what you deduct. There's maybe somewhere. So we just use basically you use common sense and a little bit of science. So common sense would be, if I have 6 children and I have a business and I have no other phone, I don't think it would be believable to deduct 100% of my cell phone expenses for my business. It probably wouldn't pass muster. Now, if I'm single and it's my only phone and this business is my life, then maybe I deduct 70 or 80%. So, but what I'm saying is a lot of these things are judgment. Every accountant, probably every tax client has their own way of doing it. I usually just ask people what their situation is. Do they have another phone line? How much do they use it for business? And then, as an accountant, does it seem believable? If it seems unbelievable, then I might challenge them on it a little bit. But generally, it's your tax return, you're standing behind it. That's the general rule. Same thing for internet. Internet is like a utility now. Everybody has it. If anybody tells me that they use it 100% for business, I suppose it's possible. So those are examples of indirect expenses. Now there are other things like auto, home office, and other things that are a little more specific that we'll get to.
Rich, could you mention maybe some art things that might be indirect?
Art things, what a concept. Okay, so art things, basically anything that goes into the product, art supplies, advertising. Now, one thing you can do, again, with any profession, with the tax code, is something that you were doing anyway. Like if you're a food critic, and even if you're not doing a review of the bistro down the street, who knows? You might be thinking about doing a review, so you can write that off. That would be legitimate. So if you're an artist, if you're a painter, and you go to a museum, the IRS, nobody's going to know what you're doing at the museum. Maybe you're there to pick somebody up. I don't know. But you're an artist. It's one of the perks of being a freelancer, is whatever that business is, you pretty much, again, within reason. If you have $2,000 of income and you subscribe to memberships to every museum in the country, that's not going to fly. But again, things like museum admissions, magazines, shows, networking events, traveling to shows, all those things are deductible, even if they're not directly part of your product.
What about like professional associations?
Professional associations, absolutely, goes for any line of business. Trying to think of other things that are specific to artists. John?
Website subscriptions,
Mhm.
software.
Oh yeah. Well, I'm trying to think of things that are specific for artists, but absolutely, these are all things that are necessary for you to run your business. You know, there are people who are film producers, and they deduct their cable subscription. So you think about things that you do in your profession or in your specific art niche that makes it unique, you can generally deduct it.
So I can deduct Burning Man.
Right, so that's funny, somebody else asked me that today too. So the specifics, I'm not going to get caught on the spot for any specific person. It depends on your individual situation. So again, with the IRS and the tax code, it's all about context. So somebody goes to Burning Man, it costs them $2,000, and let's say their art income for the year was $30, and they had that for 5 consecutive years. So basically they're showing no income, and they're deducting Burning Man and everything else. That might not pass muster. But if you're showing some reasonable income or some growth in income, and you have other expenses, then Burning Man might fit in. So it's all about the context. I'm going to look quickly at these scans and see what other I have for on these undeductible expenses. Okay, everybody wants to know about LLC. We'll get to that. Sole proprietorship in LLC, 1099, W-2, Schedule C. We'll get to that. Ooh, okay. Sales tax. We'll get to that. We might get to that. Any other questions about this section? Okay. Contractors and employees. Okay. So, God, lots of good questions here, Jessa.
Yeah, they made them up.
Can somebody please sort these out for me? John?
If I run a computer and a internet hookup from my studio, say separate from my home,
Yes.
then ostensibly we'd say that I'm hooked up to the internet at my place of work, for my place of work, for interactions in work. Could that be 100% deductible? Could it?
Yeah, the presumption is basically, it's just like the company where I work. I mean, we may be doing personal things here and there, but it's all considered business. So there's a presumption when it's a business space and a business activity that everything is business related and you don't have to separate it out. There are only a few exceptions like auto, but generally stuff in the office, utilities, yeah.
Over here. Over here.
Yep.
If you're out of town for a legitimate business trip, is there such a thing as a per diem?
Yep.
deduction, or do you have to save every receipt?
We're gonna get to that. Okay.
Wrote it in. What about donating time as advertisement as a write-off?
Nope. That's an easy one.
Oh.
Time is not a deduction. Either for business expenses or charitable donations, time is not a deduction. It's got to be something tangible, money or goods or like a gift of stock that John, your stockbroker, has advised you to give away to artisans, something like that. Okay, so yeah, this is one of my favorite ones is meals. So there is a deduction for business meals. It's basically comes out to be 50%. You report the total amount, but then the deduction is 50%. I imagine that's because I think the IRS and Congress figured out people kind of take advantage of this loophole a little bit. So there's no minimum, or what they call de minimis rule that says there's a minimum amount for business meal. However, when people come in and they give me their whole list of their Dunkin' Donuts or their Starbucks daily brew, I generally tell them that that's not the intent of the business meal. The idea of the business meal is you actually have a client or a colleague or an employee or a prospective client or an adversary, and you have at least one business discussion. That's all it really says, is one business discussion. And then you can write off that business meal. But again, it should be a meal, or it can be a snack. It can be anything like that. But it has to be with someone else. It's not just you. You don't get to write off your business meal any more than I do as an employee. So it's basically if you're actually doing business with someone else. That's the intention of it. Bonafide business discussion. Which can be with your spouse, if your spouse is in a related business. Colin?
Yeah, so with modern technology, what counts as somebody else? Like,
I mean, if I'm eating here and you're eating over there in Yugoslavia or something?
we're Skyping or texting or emailing or editing the same Google Doc or...
But this is in reference to if you're having a meal.
I could be eating
at the same time.
Yeah.
Yes, I believe so. Unless you can figure out a restaurant where you're paying them while you're in different places and they're serving you remotely. I don't know, that's probably going to happen at some point.
Do you want to take this to a Starbucks? There might be a...
There probably is. Yeah.
And if you're splitting the bills, then so the bill then, can you still deduct at least your part? Or?
Oh yeah. Then basically the whole meal becomes deductible. Your part and your client or your colleague's part. Yeah. Okay. Automobile. Okay. This is about real travel, not virtual travel.
Deduct your art card?
The what?
You deduct your art card?
Your art car?
Yeah, on the playa.
What's an art car?
Anybody? It's a hacked vehicle with.
It's a what?
It's a hacked vehicle made to look like a giant squid on the playa.
A piece of art.
A piece of art. It's a mutant vehicle. A mutant vehicle.
Is it here?
Gives us
That's the burning man.
Oh, okay.
Karen, yes you can.
Only if it's here. So with auto, there are two ways to deduct automobile expense. And what doesn't count is if you have, like John is going to his office, even though he's a freelancer, he has a studio, or Camilo has a studio, going to that office is not deductible. That's part of your commute. And now, if your office is at home, then any place you go for business is business mileage. If you have a studio or something like that, then going to that studio and back is a commute. But going to clients, or going to Staples, or doing anything else business related is considered business mileage. So the smell test for this is one area that's can be scrutinized by the IRS, and especially certain states like Massachusetts can get very fussy about records for mileage. So first I'll tell you what the rule is, and then I'll tell you about the fussiness. The two ways are, there's the simple way, which is your business mileage times whatever the mileage rate is for that year. And the IRS updates its mileage rates every year, sometimes twice a year, based on cost of gas mostly, cost of transportation. It tends to be very generous if you're moderate or working income, because it's based on average scenarios. Right now it's 55 and a half cents per mile, per business mile you get to deduct. So that's the easy way, and what you need to do, or what you should do, is keep some sort of a log showing what your business transportation was, where did you go, what the mileage was. The other way, which works if you either have a very expensive vehicle, or say you're a contractor and you do a ton of work and you have an old pickup but it's all for business and you're always putting money into it and it costs a ton of gas, you can use actual, which is your actual gas, cost of the vehicle, interest on a loan, repairs, all that stuff. There are some rules in terms of what year you can use what thing, but basically those are the two scenarios. And it's just for the business miles, so it's not for all your miles. Now, if the IRS audits you, this is one area, like meals and entertainment, where they know there's a lot of abuse. So, at the very least, even if you're not going to keep a log, and you should keep some sort of a log, even if it's not a daily log, you should keep some sort of a log, is at least be able to show how many miles you went for the year. So if you have service station receipts showing what your beginning mileage was at the first checkup and then the last checkup. Because otherwise, it's going to be the smell test. If I'm an accountant and let's say I have an office and I visit elderly clients within a 3-mile area and I'm claiming 30,000 miles for business, and then they look at the receipts and actually only drove 10,000 miles in total, that usually doesn't go over too well. Everybody follow that? I'll get to you in a second. So the IRS is sometimes, it depends on who examines you, but you may not have to do a daily log. I did have a client, still a client, believe it or not, but they're a filmmaker in Massachusetts, and they got audited and they allowed most of the deductions. Now, my client, of course, he had nothing. He had nothing. And then he was about to prepare a log kind of retrospectively. They didn't know this, but I said, do a retrospective log, maybe do it by month, because he didn't remember every single place he went. The Massachusetts Department of Revenue said, we need a list of every single place, the beginning address, and the ending address, and the mileage, and the name of the places, and they did not pack that. So it is possible to get that level of scrutiny. Again, not necessarily from the IRS, but if you're in Massachusetts, it is possible. It kind of blew me away.
So are you saying he was audited by the state of Massachusetts?
Yes.
For his state of Massachusetts, what?
Income tax.
Really? That's...
Yeah, I mean, he was also deducting these, I believe, as part of the more, yeah.
So what are the items that we need to keep in a log, and you have to keep some sort of receipt or something to go with that, or just keeping a log proves that and that's your backup?
Okay, so if you're doing the mileage,
Yeah, if you're doing it by
mileage, then you just need to keep a log and also have some backup to show what your mileage was at various points during the year, and certainly the beginning of the year and the end, at the very least. If you're doing actual, then then you need to save the repair receipts. Do you need to save every single gas station receipt? Probably not, because even with gas, if you can show this is the mileage on my vehicle, this is the number of miles my vehicle gets, something reasonable. I mean, the IRS is also, in general, is not interested in scrutinizing every last penny. If they see that you've made a reasonable effort and things make sense, then usually you don't have anything to worry about. It's only when they start to see a pattern, then they would dig deeper.
Is this exclusively for personal automobiles, or can you deduct mileage for public transit? If you're going to meet clients or something?
No, if it's public transit or general travel, you would just deduct the actual cost.
The actual cost. Okay.
Yeah.
If you're going on a road trip, the point of which is the art that you're making, then can you deduct the mileage from the road trip?
For a road trip,
Like, I'm gonna drive to New Mexico to paint, so can I deduct my mileage driving to New Mexico?
right, so this is like the can I deduct Burning Man question. It depends on the context. If that's truly what you're doing and that's the purpose of the trip, and you have, in general, if you have some other income that you're declaring and it's a business where you've been declaring income and expenses for several years, then yeah, I mean that's what you're doing. Now, technically, should you break down the percentage of personal stuff if you have an extra few days and you do something else? You probably should. Would the IRS know about it? Probably not. Things I shouldn't say.
Say I have a debit card or a credit card with the bank account for my own business, and I use that for most things. Does that serve as a record, as opposed or distinct from receipts?
I think it depends what it is, if there's enough information on there. So probably for gas, it probably would be okay. For something else or something larger, you probably want to have the underlying receipt. Okay. Home office. Okay, so home office. The technical rule is exclusively for business use. You can never use your home office for anything other than business use. So, as I was telling somebody today, the IRS actually doesn't generally come to your home. So this is also the smell test. So the rule is that this is a space in your house. You can be renting or you can be owning, but it's used exclusively for business. And then there's a formula based on either the number of rooms or the percentage space you have, and you get to deduct things that you would not normally deduct. Rent, utilities, depreciation, which is basically the cost of your home over a certain number of years. Again, this is the smell test. Artists tend to have larger studios and home offices than other professional people. But still, if you're going to say 50 or 60%, to me that usually seems to be pushing it. Again, it depends on your home. It could be, you could have a wood carving studio and it could be half of your place. If you have a large family and you say half, that's probably not going to be true. So a lot of these things are about context. And I do believe the IRS is coming, I think it's next year, they're coming out with a simplified home office calculation. Okay, so everybody worries about being audited. These are some things you can do just in your normal matter of business. There's not a specific rule in the IRS book that says if you show a loss in 3 out of 5 years, you'll be audited or you'll be reclassified. It's just a rule of thumb that you want to try to show profit. Obviously, people want to have profit, and the burden of proof might shift to you at some point to show or to prove that you're in business to make a profit and that it's not a hobby. Now, that said, for artists, writers, creative people, filmmakers, the projects do tend to take longer than, say, if you're just opening a medical practice or a computer consultant, where you'd be expected pretty much to make a profit, within the first couple of years. With artists, it could be several years. I have some that are on their second decade, third decade. That's probably pushing it a little bit. It doesn't mean that it would stand up to scrutiny if they were audited. So if you were audited, and let's say you had losses year after year, you would have to show that even though you haven't made money, you're in business to make money. So some ways that you can do that is doing things like keeping a log of galleries that represent you. Again, even if you haven't turned sales, you're keeping a log. You hire an artist representative. Separate bank account. So anything that costs a little bit of money that you wouldn't be doing otherwise is helpful for these purposes. So we'll get into this in a little bit, but unless you're incorporated or an LLC, you don't have to have a separate bank account for your art business. It's not required. Banks don't require it, the IRS doesn't require it. But for these purposes, it's helpful. It's also very helpful for accountants because it makes it easier for you to extract the data instead of it being mixed in with your groceries and everything else. Keep good records. You can consider becoming an LLC. Tracking inventory. This is a little bit complicated, which means if you do that, then again, it goes to show that you're serious about doing this. You're keeping records, you're keeping track of what you're selling, what your cost is, what your profit is. So none of these things preclude an audit, and none of them means the audit's going to fly through, but they are things that go to show that you're in business to make a profit. Questions about that?
There's one little thing there, report any income no
Right,
matter how small.
right, right.
But wasn't there a time when like anything under $300 didn't have to, no? Like,
That you didn't have to?
Yeah, like if you did one job for a client and you got $300 over the course of the whole year, no?
No, you might be thinking of the 1099s. So the 1099s are forms you get if you're freelancing and you're not incorporated. You only get a 1099 if you made $600 or more from that specific vendor, that specific client. But you're still expected to report technically you're supposed to report yard sales, technically. Now nobody expects you to, but.
I have a question.
Yeah.
How many years should you keep the records for? I mean, how far back can they go?
Yeah, well, we'll get to this, but generally, minimum of 3. I mean, you should always do 3. If you're self-employed, you should probably do 6 or 7. The IRS can go back 3 years, and generally they're so backlogged that by the time they get to it, it might only be 1 year. But if they suspect substantial underreporting of income, they can go back 7 years.
Can you repeat the question for us, please?
What about selling equipment? Selling equipment actually doesn't go on the business part. It goes with the part as if you're selling securities or investments. But again, if it's just a small amount, I would just put it in income. I wouldn't get too detailed about it unless it's a major piece, or unless you're doing it, unless that is your business. Now, before I forget, crowdfunding. Kickstarter. Anybody have any Kickstarter projects, or Indiegogo, or Rocket Hub? Quora, all those things. So this is does everybody know what this is? So, the question has been, what if you're lucky enough to be doing crowdfunding and to receive money for it, is it income to you? Because this crowdfunding is a new concept. It's not, unless you are a nonprofit that's doing the crowdfunding, that's asking for money. Unless you're a nonprofit, it's not a donation, okay? And it's not a donation from the person giving money. And it's not an investment in your company. Well, I have a caveat about that. But in general, it's not an investment in your company, which is also a different sort of tax activity. So the question is, what is it? Well, in general, it's income. If you're crowdfunding, and I'm starting Rich's film of Rebel Headquarters, which is our parties that my family does occasionally, and I'm asking for money, and with crowdfunding, you're giving something back, whether it's a copy of the video or a hand stamp or whatever it is. You're giving something in exchange. The IRS will view that as a sale. So there have been cases already where people are getting $1 million, $2 million. Somebody's getting something back. It's income. If you have any doubts about it, in general, I believe if crowdfunding, if you're getting $20,000 or more, actually, at least Kickstarter, I believe, will issue you a 1099-K for that income. The only caveat is there is a new bill that was passed last year called the Jobs Act that allows for Kickstarter and crowdfunding to be basically like securities. That basically somebody else could take a stake in your company through Kickstarter. That would be different, and also they wouldn't be getting something in return, they'd be getting a share of the company in return. But the general run-of-the-mill, for-profit, small activities, that's income. Aaron?
Can you just, okay, so say for example, you're asking for $25,000, you're a jeweler, this happened actually to the people who do the dice rings. They made $374,000 on their little venture. Is there any way to spread the income out over several years, or do you have to just like gulp it up?
Gulp, was that the word?
Yeah.
Yes. Well, it's whenever the money came in. Yeah, you can't, there's no income spreading. Now, of course, you get to deduct your expenses.
Right.
But no, it's when it came in. So it's just, at that point, you're just like any other business. It's startup money.
And so if you spent a shitload of your own time with the fulfillment of that campaign, making all these postcards or sending out all these pieces of art or whatever that you promised in the rewards, and versus then that's all you can't deduct that, but if you hired somebody to do that, you could deduct that. Okay.
Because you're paying someone, just like you're paying for printing or paying for postcards. Your time, even though you are the owner, is not deductible.
Can you pay yourself? Does that change if you're an LLC and pay yourself?
Right. So yes, you can. Well, if you're a sole proprietor, which means you're not incorporated, you don't pay salary. You can pay yourself. You just take money out of the bank. That's paying yourself. If you're on salary, yes, you can. Jessa has Funnel Cake Incorporated. You can put yourself on salary and deduct it. However, then Jessica gets to declare that money as income to you because you're paying yourself. So it's just one pocket to the other pocket. But plus, then you actually get to pay some more payroll taxes. So time or paying yourself is not deductible. It's too easy.
Since you are giving a reward in return for these donations, does that count as something that you need to pay sales tax on?
To the best of my knowledge, I haven't heard of that yet being an issue,
Well, that's actually a good point.
but it's a good question. I don't know if the states have caught up to that
If I do a
yet.
Kickstarter and I'm trying to write a book for it,
The what?
I'm gonna be doing a Kickstarter this year and a book, for a book. So if I'm giving a reward for that
Right.
book, is that, how does, you know,
Yeah, I think,
might be a tax guy?
yeah, right. Don't put me on the spot. So, sales tax is very specific. It's state by state, but there are things where I think where they just can't get around it. I mean, they can't get. It's a little bit too peculiar for them. Just like bartering. Bartering also, theoretically, if I sell a painting to my accountant for $1,000 and he does my tax return, technically that's income to me. I mean, you're each supposed to record it, but it doesn't get recorded anywhere, so I don't think the sales tax people get to it. The same thing with the Kickstarter. Again, I'm describing it as a sale because that's the logic the IRS would use to say, and is using to say it's taxable. But to say that then it becomes a sales tax item, I haven't heard of it, but the states are desperate for money, so you never know, but I haven't heard of it yet.
So which state do you get sales tax in, if it's across the board? Like, let's say Massachusetts.
We'll get to sales tax after 10 o'clock.
Just a comment on Kickstarter that
The what?
on Kickstarter they're revamping their policies and they're cracking down on people. They do not want to be a sales store, so they're trying. When you put something up as a reward, you're not supposed to be a store that is selling something. It's supposed to be a reward.
Right.
So
Right.
that is their philosophy on it.
Right. So that's why I think, since it's worded as a reward, it probably is not sales taxable.
Yeah.
But because underlying that is the concept of, even if you're not calling it, it's an exchange for value, therefore it's income taxable.
Would you suggest that if someone is going to do a Kickstarter, they should consider how much money they are going to receive and how to structure themselves to receive different amounts of money? So for instance, to receive $10,000 may be enough to do your project, but if you wind up in a situation where you're going to raise $375,000, it might be wiser to think about the structure that you're using to fulfill your project.
Yeah, well, the problem is, I think sometimes people don't realize how much sometimes they get more than they expect. They're not prepared for it. Yeah, I think the tax implications can totally take people by surprise. Okay. There were a lot of questions on.
Rich, it's 7:30, just giving a time check.
Okay. Okay, so so I'll try to cover two topics. Not this one yet. Incorporation. So as a sole proprietor, again, you're a freelancer, you're not incorporated, you're not an LLC. The advantage of this is it's cheap. Actually, it doesn't cost anything. You pay taxes, but there's no legal setup, there's no separate tax return. It's part of your individual tax return. You don't have to keep a separate bank account, even though I would recommend it. The downside is there's no legal protection. So in the eyes of the law, the IRS, vendors, if you have a couple of vacation properties and you make a product and somebody sues you and your insurance doesn't cover it, or you don't have enough insurance, they can come after your assets. If you're renting and you're making $10,000 a year, then legal liability, and you're making painting. I mean, painting is not really as a profession, I think, where people get sued a lot. So you have to consider those things. So sole proprietor basically is a default. You get a 1099, you're essentially a sole proprietor. So there are two other ways to go. One is you can become an LLC, limited liability company. Limited liability company is fine. What it does is it gives your sole proprietorship legal protection. That's all it does. It doesn't give you any tax benefits that you didn't have before. It's the same tax form. If you're one person, it's the same tax form, it's the same evil self-employment tax, it's the same everything. If you need it for legal purposes, or sometimes in certain professions, people want an LLC because it sounds better, or applying for grant. I mean, there are all kinds of things that come up. Then you can do it. Certain states like Rhode Island, if you're a one-person LLC, you get to pay $500 a year for that privilege. In Massachusetts, you're a one-person LLC, there's no extra fee. I mean, there's a filing fee. There's an annual filing fee. Yeah.
It's $500 a year in Massachusetts as well for an LLC.
I don't believe that's true if you're a one-person LLC.
Like,
With LLC can be one person, or it can be multiple members. The multiple members pay the $456 corporate fee.
Because I have a regular business and they ask for $500 a year.
Is it one owner?
Yeah.
One owner LLC?
Yeah. It's a regular business.
Right. What do you mean by regular
It's
business?
it's an engineering firm, but it's a one-person thing, and they ask for filing fee every year.
A 500?
Yeah.
Okay. I stand corrected. I guess we would know.
Does it, if you picked a place that didn't have that fee, like Vermont or something, would that be better, or does that mean you have to start filing Vermont taxes and go?
Well, yeah, it would be better, but it would be illegal if you're doing business in Massachusetts. So then you would be registering as a foreign corporation in Massachusetts and paying Vermont and still paying the same fee in Massachusetts. Just like when people say, well, I want to incorporate in Delaware,
Yeah.
that's fine. And that's important if you're going to be publicly traded on the New York Stock Exchange. But you're doing business in the state you're in, that's where your office is, that's where you're expected to register and pay taxes. So I'll have to look at that, because I wasn't aware of that, unless maybe it's something new, I don't know. So the other option is you can become a corporation. There are two kinds of corporations. There's what's called a C corporation. Those are generally larger corporations or multi-member corporations. They're separate from, they're a separate entity. They file a separate tax return that has its own tax rates and tax codes. It's called corporate tax rates. Most small businesses do what's called an S corporation, which means it's still a separate tax return, but all the income and all the expense goes on your personal income. So it's a little simpler, it's not as complicated, and there are some slightly complicated ways you can save money being an S corporation. If you have sufficient income, you can save some money on payroll taxes, maybe even $3,000 or $4,000 a year, if you have enough income. Any questions on that?
Ballpark, what must you consider enough income?
Net, if you were netting, say, at least $40,000 a year, 40 or 50 net after expenses. What would be enough income to justify looking at being a corporation, an S corporation? So if you were making $40,000 or $50,000 every year, consistently, you might be able to get some savings. Okay, sales taxes. Sales taxes is a sales taxes is a whole topic unto itself, and I've done seminars just on sales taxes. And it is, there's no national sales tax. It's very state specific. States tend to be pretty aggressive about sales taxes because they see it as low-hanging fruit and it's visible. They can see where people are selling stuff. So that's another reason you have to keep good records, is you're probably even more liable to be audited for sales tax than for income tax. I know that's true in Rhode Island. Yeah.
Is it for, obviously when you sell an object, somebody's got to pay sales tax on that. What happens if you're doing like a seminar or teaching something? Where's that sales tax fall into that?
All depends on the state and the locality. So sales tax is, when I was doing this webinar for a guy in Arizona, he said, we have an Arizona sales tax, we have a county sales tax, and I think that they have a city sales tax, and they're all different. So it can be all over the place, and it could be all over the place what sales taxes are not. Usually, at least in the Northeast, I think most professional services are not taxed. But again, different in every, Rhode Island I know does not tax services, although they talk about it every year, so you never know. And I think the same is true in Mass.
Yeah. One time I was doing a lot of shows, and I was like, I had to have sales tax in about 7 or 8 states.
Yeah.
You know, and you know, they are very aggressive.
Right.
Even if you don't even make sales,
Right.
you have to file.
Yep.
Sometimes quarterly, sometimes yearly.
Right.
I was in New Jersey once, and I hadn't done business there in quite a while, and they were coming around. There were about 7 of them with clipboards, and
So at a show?
they at a
Yeah.
show, yeah, at an art festival, and they came around, and they were demanding money even if you hadn't done business. They were demanding a certain minimum amount a quarter. And if you didn't come up with it, and they gave me, I know some people.
What do you mean came around? Like
They came around with a clipboard. They
Right.
and saying that you hadn't filed a tax return here in 3 years. And I said, well, I haven't done business here in 3 years. You're required to anyways, even if it's 0. And they demanded a minimum of, I think it was $50 a quarter from me for those 3 years just for not filing. And if I didn't come up with the money in 3 hours, they were going to seize all my inventory.
Wow.
Yeah, they are very aggressive.
Yeah, New York has something like that.
And another interesting thing, and I've talked about this with a friend of mine, when you're accepting credit cards and you're
Yeah.
putting your sale there, and then you're adding your sales tax to that, and then the bank takes, let's say, whatever it used to be 3, 4, 5% of the sale.
Yeah.
The bank is actually taking a portion of your sales tax. They are keeping a portion, and I don't understand why. I mean, what I'm trying to say is the banks are making money on sales tax, and I think that
Right.
probably is something that's really overlooked in a lot of ways. I don't know what.
Yeah, it's almost like the cost
So the
of doing
banks are
business.
charging
I mean,
their fee on the gross,
Yeah.
Right.
not net of taxes.
Right, so your
Right.
sale
Yeah.
of your products
Yeah.
there, plus your
Yeah.
sales tax, and you're giving your
Right.
bank
Yeah.
the total, and they're taking a piece.
Yeah, because the bank doesn't care that you're not
They don't-
getting to keep all that money.
I know.
Right. It's not their problem.
But I'm sure if I know this, the IRS knows it, but they allow the banks to get away with it. And some,
Right.
yeah,
So,
anyways, it's just my beef.
so actually, I heard a similar at one of these presentations in Rhode Island. I heard a similar, not quite with the clipboards and
Oh, yeah.
people
They're
in
pretty
dark
tough.
suits and stuff, but I heard a similar story
Yeah.
about Massachusetts. She went to one show in Massachusetts, and they kept assessing her fees,
And now a lot of
Similar.
it, there's no more paper mailing. So, in
Right.
other words, it's your responsibility, if it's online, to know when that period is due.
Right.
They don't notify you, you're supposed to know.
Right.
And if you're doing
Right.
business in a dozen states or more, traveling, it can, you know,
Yeah, if you're doing business visibly, like going to shows.
oh, yeah,
Right,
yeah.
right. Yeah, I mean, they can ask you to register, and that's typically what they do, is they'll ask you to register when you go
Yeah.
there. So sales tax, but there are sometimes overlooked ways to limit your liability with sales tax. If you're making something, and people are makers, we're in a maker space, if you're making something that you're later going to be selling, then anything that goes into that process is you do not have to pay sales tax on. What you do is you go online and you print out a resale certificate. Every state has them, no matter where you're doing business. They may go under different names. And then you print that out, you fill it in, and then you give it to your regular vendors. Because the idea is that you're not paying twice. So if you're going to Home Depot to buy lumber, and it's going to be part of, not a house, but part of, say, some furniture you're going to be selling, then you're going to be the one collecting sales tax at the end. So you don't have, you yourself do not have to pay sales tax when you're buying that material, because then the government would be getting sales tax twice. But you need the resale certificate, and in order to have the resale certificate, you have to register with the state and then file those reports, even if they're zero. And then you can do the resale certificate. The other thing that people may not know is if you're shipping something out of state and it's by what they call common carrier, which means UPS, post office, anything other than your own vehicle, it's also not subject to sales tax in that state, which means you as the seller are not responsible for collecting.
Say that again.
So if I'm in Connecticut and I sell something to somebody in New York and I send it to them UPS, because they're out of state, it's not sales taxable in Connecticut, so I don't have to collect that, or I'm not even allowed to charge sales tax to that client. Couple more questions.
If you sell to nonprofits, like educational institutions,
Yep.
what do you need to get from them so that you don't charge sales tax if you're not supposed to?
Yeah.
What happens if you do by mistake? What are the things you got in that?
Generally just an exemption certificate, and then they don't have to pay sales tax. Was there another question with that?
No, then
That's-
just additionally.
If you do it by accident and they catch it, then you should refund them the money.
And if you have a website, should you be charging sales tax on your website for what you're selling on your website?
If it's a website, it's the same rule basically. It's only in state. So that's why you'll see if you're buying something online, it'll say except residents of Illinois, because that's where the company is located. So in general, internet sales are not taxable. That's changing a little bit. Some of the bigger companies like Amazon now have, well actually, it's actually, they haven't changed it, but a lot of the bigger companies have been kind of prosecuted by the different states where they have agents and they essentially have activity, even if it's like not a brick and mortar facility. So they're considering some changes that will make internet sales taxable, but it's going to be a pretty high threshold. So until you're really raking it in, it's still generally sales tax. Sales tax.
So I shouldn't be charging mass sales tax on my website, and even if the people who are buying
Resident, only for mass residents. For residents. If you're doing business in Mass and you're shipping in Mass, then those people would pay sales tax. Other people won't. Okay, I got the signal to wrap it up.
No,
Right?
just go through your questions.
Oh, that's what you're saying. Okay. Okay. Donations of time, use as advertising. No. Karnak, magnificent. Ta-da. What is the preferred method of record keeping? Excel or by hand? Right, or QuickBooks. Okay, so that's a really good question. For me, I don't really care what form it's in as an accountant, as long as it's readable and it makes sense and it adds up. I wouldn't say I like QuickBooks, but QuickBooks there are only a few programs. I like accounting programs because it spits out nice lists in nice forms, and I can look at the program and I can decipher things. If you're not up for the expense, or if it's too difficult, if you can keep track of it in Excel, that's fine. And say as your business grows, Excel may not quite fit your needs. If you have a business that's a corporation or has other partners, I would not use Excel. I think then you have a fiduciary responsibility to keep better records because you have other investors and partners. Or you can be like the people that just come in every year and they just make it up on the spot. Somebody was asking. And then you don't have to write anything.
What about people who don't do proprietary software?
People who what?
Don't do proprietary software.
Which means what?
Anything that runs on Microsoft or other people's operating systems.
Open up the spreadsheet.
Linux users.
If you can, I mean, I don't know how to use it, but if you can give me the information, I mean, the taxpayer is responsible for the information. So I might not be able to read the file, but if you can show me what your income was, what your expenses were, what your cash was at the end of the year, that's fine. It's all what it looks like. You just want to do some, you can get QuickBooks, just if you're going to use it properly. That's what I would say. Quicken, I would not recommend because it's pretty limited.
For records, do you have to retain paper copies?
No. I don't think so. But that's something I can get back to you about that because people have been asking me that. I think any kind of record, if it's legitimate, will be okay. You're talking about like bank statements that are online? Or you mean
Say as I'm receiving records for transactions, whatever, I'm making a sale, I'm buying materials, any of those things.
Right.
And I'm scanning those records and keeping those scans, and then maybe I throw a bank box or
Right.
whatever. Do I need to be able to retrieve those
paper records? I'm not sure. The only reason, I'm just not sure because it's so new, and I'm not sure what the rules could be, or if they could, there's a danger of fabrication of records. But it's certainly headed in that direction, so I think there'll probably be more information about that. How do nonprofits fit into the picture? Well, they're not really part of this picture. If you want to be a nonprofit, or if you want to be a profit, be a nonprofit. We service a lot of nonprofits, but that's an entirely different process. We did that. Estimated taxes. What's the easiest way to keep track of and pay your quarterly taxes? Okay. Yeah, so if you're a sole proprietor and that's all you do, you don't have a regular employee job where you have taxes withheld, then pretty much the only way you're going to pay is at the end of the year, which means you're going to end up, if you were fortunate enough to make a profit, you're going to pay a lot at the end of the year. And you're probably going to get penalized as well because you're not supposed to all pay at once at the end of the year. So there's a system called estimated taxes. And what it means is, let's say I'm a freelancer, I make $50,000 during the year. That's my net income for the year. That's all I've got. I don't have any employee job. So every 2 or 3 months, there's a recommended schedule. It's not a required schedule, but there's a recommended schedule of every 2 or 3 months, 4 times during the year, when you pay your quarterly installment of estimated taxes to the IRS and to the state if you are lucky enough to live in the Northeast or some other place where you have income taxes.
What is that rough schedule?
Well, you mean the dates?
Yeah.
Well, the dates, the recommended dates, if you estimate your liability for taxes and divide it by 4, you do April 15th, June 15th, September 15th, and then January 15th of the next year. So it's kind of an odd schedule. It's very confusing because if you're self-employed and you're paying your taxes on April 14th of 2012, well, then April 15th is when you should be paying the first installment of the next year. Does that make sense? I mean, it's ugly, but it makes sense. So especially if you're somebody who pays even later, you go on extension and you don't pay your 2012 taxes till October 15th, 2013, and you haven't even started paying on your 2013, and when it gets to 2014, you're just going to keep getting further and further behind. So that's the idea of the estimated system.
If April 15th, whatever, July 15th, October, does it have to be in by the 15th? Or
No,
mail
so yeah, so these are only recommended dates.
Ah.
So it's an easy way to think about it if you can be on schedule and you know what your income is. Because what the IRS will do is if you pay, say, all at the end of the year, then you're going to get penalized for not spreading it out during the year. So if you do these quarterly installments, when they run their tables, it basically will have spread it out during the year. But that said, if you pay a few days late, in general, it's not going to make a whole lot of difference. Or you can pay a few days early. I mean, in general, if you're self-employed, you can only pay what you can pay. So your first installment might end up being less than it should be, and you might have to make up for it later. Or your income could change. So they're all different circumstances. They're recommendations. If you have a steady income that really doesn't change year to year, and there are some freelancers like that, then yeah, you should use that rule. But if your income is really subject to wild fluctuation, you're probably going to have to improvise.
What is the penalty if you pay at the end of the year?
It can be up to 15%, but again, it's a calculation. It's not 15% of the amount you owe. They're going to figure out what your last year's tax was, what you should have paid, how many days late, what the interval was in the payments, what the square root was, all these other things. So it depends. If you owe $10,000, it could be $400. If you only end up owing $400, it's probably not going to be very much.
What's the threshold at which you should start paying that quarterly schedule and not paying until the year?
And not paying at the end of the year?
Yeah, what's the threshold, like when you reach what point that you should be paying 4 times a year?
It's not really a point. The question is, are you going to be penalized? And is the penalty going to be something you can live with?
So at what point can you become penalized?
You can be penalized basically. So the basic concept is, if you're an employee that you're paying out of your paycheck, even if you're withholding change during the year, it's considered by the IRS to be given basically equally throughout the year, even if that wasn't true. So, but if you're self-employed, they're going to go by the exact date. So they're going to look at, I'm trying to think. So your question was, when do you know that you need to be paying
Quarterly as opposed to by
at the end of the year? Right, so if when you're filing your taxes for the prior year, you're getting, first off, you're getting penalized.
So it's like a trial and error. You get penalized first time, next time you should.
Well, it depends. I mean, there's some people who they get penalized every year, but either they can afford to, or they can't afford not to. So they just keep on doing it because they don't have any choice. So when it's, you know, paying at the end of the year, if it's a couple of $100 and that's okay with you, and because remember, that means you're also paying the tax at the end of the year too. So everything's backlogged. So it just keeps running into the next year. So it really depends on your own threshold. I mean, technically, it's a good way to do business. You know you have this liability. You're going to pay it quarterly, and then you're going to stay on track. And that also protects you. Say your income goes up the next year, then your taxes are going to go up. You know, so if you already have this backlog from the last year, it's just going to keep compounding. But the IRS really doesn't care as long as you keep paying. They're just going to keep on adding interest and penalties. Yeah.
So if you are doing crowdsourcing, and
The what?
say you're doing crowdsourcing, so most of the year you're making next to nothing, but you get this payout from Kickstarter in
Right.
December,
Right.
are you going to get penalized for not having paid?
No, okay, so yeah, so there's a caveat with estimated taxes. With the penalties, you're still going to get taxed, but the penalties only kick in if you didn't meet your prior year threshold. So let's say you were paying $2,000 in taxes in 2011. Your taxes all of a sudden become $50,000 for 2012. You're not going to get, and you only paid $2,000 in 2011. Does everybody follow that so far? So your taxes jumped in 2012. You're only going to get penalized for 2012 if you didn't pay that $2,000. In other words, your income goes up, that's not subject to the penalty. So it's a safe harbor. So whatever you made in 2011, that's your safe harbor to pay for 2012. If you make more in 2012, you still have to pay the tax. You're not going to be penalized if you don't pay that tax before April 15th. You can see me after if you
What happens if you're,
And then one more.
if you had irregular income, say you made
Right.
$10,000 in one quarter, $40,000
Right,
in the quarter.
right.
Do you have to pay the same amount that your quarterly income estimated, or did you pay it based on what you made?
Right, so yes, you can do that, and then there's a separate schedule with the IRS that you can file where basically will figure your estimated taxes based on your fluctuating income. Basically, you'll be giving them the same information you have, and then it'll calculate what your estimated taxes should have been. Okay. It's got to be the last one, I think. Time drinks.
Mine's really quick. Is there a specific form for these quarterly things that you can get online, or are you just sending?
Yeah, well, it's ES. I mean, they're vouchers, or if you're using TurboTax, I don't know TurboTax, but I think there's an estimated tax worksheet.
So it's not you don't get this from the IRS. You have to make your own.
Well, you get the form from the IRS, but the IRS doesn't know what the form isn't going to have your numbers. It has to be related to your tax return.
I guess I'm asking, can you go somewhere online, download the form, and then you can fill out your information and send it to the IRS? Or is it like you're just sending payments to the IRS?
The IRS just wants the voucher and the money.
Okay.
But yes, you can. You can go over to the IRS website, and actually, if you call them, even also in the Department of Mass DOR, they're